Welcome to our in-depth guide on cryptocurrency investment strategies for 2024. As we step further into the digital age, the impact of cryptocurrency on the global financial landscape is undeniable. It's a brave new world out there, and cryptocurrencies are the new frontier of finance. But what exactly is cryptocurrency? Well, in the simplest terms, cryptocurrencies are digital or virtual currencies that use cryptography for security. They are decentralized, built on a technology called blockchain, which is a distributed ledger enforced by a network of computers or nodes. The first and most well-known cryptocurrency is Bitcoin, which was created in 2009. Since then, thousands of alternative cryptocurrencies have been developed, each with its own unique functions and applications. Some aim to improve on Bitcoin's perceived flaws, while others explore completely different use cases, from smart contracts to tokenizing real-world assets. In the current financial landscape, cryptocurrencies have become a popular investment asset, offering potential high returns. But, like any investment, they also come with risks. The market is volatile, and prices can fluctuate wildly in short periods. However, with the right strategies and a clear understanding of the market, investing in cryptocurrencies can be a rewarding endeavor. The growing acceptance of cryptocurrencies by major financial institutions and corporations is a testament to their staying power. Today, you can buy a cup of coffee, book a flight, or even buy a house with cryptocurrencies. And as more industries adopt this technology, the potential for growth is substantial. It's important to mention that while cryptocurrencies offer exciting opportunities, they are not suitable for everyone. They require a good understanding of the technology behind them and a willingness to take on a high level of risk. It's always recommended to do your own research and possibly seek advice from financial professionals before diving into cryptocurrency investment. Now that we have a basic understanding of cryptocurrencies, let's delve into various investment strategies. Before we dive into investment strategies, it's crucial to understand the dynamics of the cryptocurrency market. Now, the cryptocurrency market isn't your traditional stock market. It's an entirely different beast, known for its volatility. It's like a wild roller coaster ride with dramatic highs and sudden lows, sometimes within the same day. This volatility, while unnerving, is also what makes it possible for investors to achieve substantial gains in a short period of time. But remember, with the possibility for high returns comes high risk. It's a double-edged sword. That's why understanding market trends is so vital. Trends in the crypto market can be influenced by a variety of factors, from geopolitical events to technological advancements, to even tweets from influential figures. One day, you could be riding high on a wave of positive market sentiment, and the next, you might find yourself in the midst of a market correction. To navigate these choppy waters, you need to have a keen eye for spotting trends and patterns. This is where market analysis comes into play. Market analysis in the world of cryptocurrency involves studying price charts, understanding the indicators, and keeping an eye on news events that could impact the market. It's about identifying opportunities and making informed decisions based on data, not just gut feelings. There are two main types of market analysis you need to familiarize yourself with: fundamental and technical. Fundamental analysis involves evaluating a cryptocurrency's underlying technology, its use cases, and its potential for adoption. On the other hand, technical analysis focuses on studying price movements and trading volumes to predict future trends. Both are essential tools in your investment toolkit. Another important aspect to consider is the overall market sentiment. This is the collective attitude of investors towards the market. It's a psychological factor that can significantly impact price movements. When optimism is high, prices tend to rise. Conversely, when fear and uncertainty creep in, prices often fall. Being aware of market sentiment can help you understand how other investors are likely to behave, which can be a valuable insight when planning your investment strategy. But be cautious. Market sentiment can be fickle, and it's important not to get swept up in the crowd. Lastly, it's essential to remember that the cryptocurrency market is a global market that operates 24/7. This means that changes can happen at any time from anywhere in the world. Unlike traditional markets, there are no opening or closing bells here. So, you see, understanding the cryptocurrency market isn't just about knowing the latest hot coin or following the crowd. It's about understanding the forces that drive the market, being aware of trends and market sentiment, and using that knowledge to make informed investment decisions. Understanding the market is the first step towards a successful investment strategy. One of the most common strategies adopted by investors is the long-term investment strategy. Long-term investment, what does it mean? It's more than just holding on to an asset for an extended period. It's about understanding the potential of the asset and having the patience to watch it grow. This strategy is often adopted by individuals who believe in the future of a particular cryptocurrency, and it's especially relevant in the crypto world where things can change rapidly. When we talk about long-term investment, we're typically referring to a period of at least 1 year, but often much longer. Some investors hold on to their assets for 5, 10, or even 20 years. The idea is to ride out the volatility of the market and benefit from the overall upward trend that many cryptocurrencies have shown. So, what are the pros and cons of long-term investment in cryptocurrencies? One of the main advantages is the potential for significant returns. Some of the most successful investors in the world have made their fortunes by investing long-term. Think of Bitcoin, for instance. Those who bought in early and held on to their investment have seen returns that are nothing short of astronomical. Another advantage is that long-term investing requires less time and effort compared to strategies like day trading. You don't need to constantly monitor the market and make quick decisions. Instead, you can do your research, make your investment, and then let it sit. However, long-term investing is not without its risks. The cryptocurrency market is notoriously volatile, and there's always the chance that an asset's value could plummet. Furthermore, because you're holding on to your investment for a long time, your money is tied up and not easily accessible if you need it. So which cryptocurrencies are suitable for a long-term investment strategy? While it's impossible to predict with certainty which cryptocurrencies will succeed in the long run, there are a few factors to consider. Look for cryptocurrencies that have a strong use case, a dedicated and competent team, and a clear roadmap for future development. Bitcoin, as the first and most well-known cryptocurrency, is often a popular choice for long-term investors. It has a proven track record and has remained resilient in the face of numerous challenges. Ethereum, with its smart contract functionality, also shows promise for the future and could be a good choice for long-term investment. There's also the potential in newer, smaller cryptocurrencies. These may be riskier, but they also offer the chance for higher returns. Look for projects that are solving real-world problems, have a unique selling proposition, and have a strong community backing them. In conclusion, long-term investment in cryptocurrencies can be a viable strategy, especially for those who believe in the future of the technology. It requires patience and a willingness to ride out the market's ups and downs. Remember, though, it's essential to do your own research and understand the risks involved. Long-term investment can be highly rewarding if done right. For those who prefer a more hands-on approach, day trading might be the strategy for you. Day trading in the cryptocurrency world is akin to being a surfer in the ocean of digital assets. The idea is to ride the waves of market volatility, buying low and selling high within the span of a single day. It's exciting, fast-paced, and can be highly rewarding, but it's not without its risks. Day trading is not for the faint of heart. It requires a solid understanding of the market, a keen eye for detail, and the ability to make quick decisions. The market can change in an instant, and sometimes a single second can mean the difference between profit and loss. But for those who can master the art of day trading, the potential rewards are significant. One of the main advantages of day trading is the ability to capitalize on short-term price fluctuations. Unlike long-term investors, day traders aren't concerned with the overall trajectory of a particular cryptocurrency. They're looking for quick, profitable trades based on minute-to-minute changes in price. Now, to effectively execute a day trading strategy, there are a few key points to keep in mind. First and foremost, it's crucial to stay informed. The world of cryptocurrency is constantly evolving, and market conditions can shift dramatically in a short period of time. Keeping a close eye on news and developments is a must for any successful day trader. Secondly, discipline is key. It's easy to get caught up in the excitement of a rapidly changing market, but successful day traders know when to hold back. Setting a clear profit target and sticking to it can help to prevent rash decisions and ensure that you're trading strategically, not emotionally. Thirdly, a solid understanding of technical analysis is a must. Day traders rely heavily on charts, patterns, and indicators to predict future price movements. While it's not an exact science, technical analysis can provide valuable insights and help to guide your trading decisions. And finally, never invest more than you can afford to lose. This is a golden rule in any form of investing, but it's especially important in day trading. The market is volatile, and losses are a part of the game. By only investing what you can afford to lose, you can ensure that you're able to weather any storm and stay in the game for the long run. Of course, it's important to remember that day trading is not a guaranteed path to riches. It requires time, effort, and a certain level of risk tolerance. But for those who are willing to put in the work, the potential rewards can be substantial. In conclusion, day trading is a dynamic and challenging strategy that requires a hands-on approach. It's not for everyone, but for those who enjoy the thrill of the chase and have the discipline to stick to their strategies, it can be a rewarding way to engage with the cryptocurrency market. Remember, the key to successful day trading lies in knowledge, discipline, and constant vigilance. It's a game of strategy, and the players who come out on top are those who are able to adapt to the ever-changing conditions of the market. Day trading requires time and dedication, but with the right approach, it can yield significant returns. Another popular investment strategy is investing in initial coin offerings, or ICOs. Now you might be wondering, what exactly is an ICO? Well, let's take a deep dive into it. An initial coin offering, or ICO, is akin to an initial public offering, or IPO, in the traditional financial world. It's a way for cryptocurrency startups to raise funds by selling their own tokens in exchange for either fiat currency or other more established cryptocurrencies. The idea is that these tokens will gain value as the startup's project grows and becomes successful. Now let's talk about the potential rewards. The most enticing aspect of ICOs for many investors is the possibility of getting in on the ground floor of the next Bitcoin or Ethereum. This is because the tokens are usually sold at a low price during the ICO stage, and if the project takes off, the value of these tokens can skyrocket, leading to massive profits for early investors. Think about those who invested in Ethereum during its ICO in 2014. They paid just about 40 cents per Ether. Fast forward to today, and the value of Ether is well into the hundreds of dollars. That's a return on investment that's hard to match in any other market. However, like all investments, ICOs come with their own set of risks. The cryptocurrency industry is still relatively new and is largely unregulated. This means that there's a fair amount of uncertainty and volatility. Not all ICOs are successful, and there's always the risk that the project will fail, the startup will go under, and investors will lose their money. Moreover, the lack of regulation also opens the door for scams. There have been instances where unscrupulous individuals have launched ICOs with the sole intent of absconding with investors' funds. So it's crucial to thoroughly research and vet the team behind the ICO, their business plan, and their project's feasibility. And this brings us to how to choose the right ICOs to invest in. The key is due diligence. Look for a strong team with a track record of success. The project should be innovative and solve a real problem. The business plan should be sound, and the tokenomics, or the economic model of the token, should make sense. It's also worthwhile to look at the community and buzz surrounding the ICO. A strong and engaged community can be a good indicator of the project's potential. But remember, hype alone should not be the basis of your investment decision. Finally, never invest more than you're willing to lose. The potential for high returns is certainly enticing, but it's important not to get carried away. ICOs are high-risk, high-reward investments, and it's crucial to have a balanced and diversified investment portfolio. So, there you have it. ICOs present a unique opportunity to potentially profit from the ground up of a new cryptocurrency project. But like all investments, they require careful research, due diligence, and a level-headed approach. Investing in ICOs can be risky, but it also carries the potential for high returns. A wise man once said, "Don't put all your eggs in one basket." This holds true for cryptocurrency investment as well. Let's take a moment to understand the concept of diversification. In the simplest terms, diversification is a risk management strategy that involves spreading investments across various financial instruments or categories to minimize exposure to any one asset or risk. It's a bit like having a balanced diet. You wouldn't want to consume only one type of food, right? You'd want a mix of proteins, carbohydrates, and fats to stay healthy. The same principle applies to your investment portfolio. Investing in cryptocurrencies can be a roller coaster ride. The market is notoriously volatile, with prices fluctuating wildly in short periods of time. This volatility can provide opportunities for high returns, but it also carries significant risks. By diversifying your cryptocurrency portfolio, you can spread this risk across a range of assets, reducing your potential losses if one of your investments takes a hit. Now, let's delve into how to effectively diversify your cryptocurrency portfolio. First and foremost, it's important to diversify across different types of cryptocurrencies. While Bitcoin might be the most well-known, there are thousands of other cryptocurrencies out there, each with its unique features and potential for growth. When choosing which cryptocurrencies to invest in, consider a mix of established coins like Bitcoin or Ethereum and smaller emerging coins. The established coins tend to be more stable, while the smaller coins can offer higher potential returns. Another important aspect of diversification is investing in different sectors within the cryptocurrency market. Just as the traditional stock market has different sectors like technology, healthcare, and finance, so does the cryptocurrency market. For instance, some cryptocurrencies are focused on privacy, others on smart contracts, and still others on supply chain management. Investing in different sectors can help protect you from sector-specific risks. In addition to diversifying within the cryptocurrency market, consider diversifying across different types of investments as well. This could include stocks, bonds, real estate, and other traditional investment vehicles. This broader diversification can help protect you from the volatility of the cryptocurrency market. Now, while diversification is an important strategy, it's equally important to remember that it's not a one-size-fits-all solution. The right diversification strategy for you depends on your individual risk tolerance, investment goals, and time horizon. Some investors might prefer a more aggressive strategy, with a high proportion of their portfolio in smaller, high-growth cryptocurrencies. Others might prefer a more conservative approach, with a larger proportion in established coins and traditional investments. It's also important to remember that diversification is not a set-it-and-forget-it strategy. The cryptocurrency market is dynamic and constantly evolving, and your diversification strategy should evolve with it. Regularly review your portfolio and make adjustments as needed to maintain your desired level of diversification. In conclusion, the world of cryptocurrency investment can be exciting and potentially lucrative, but it's also fraught with risks. Diversification is a powerful tool to help you navigate these risks, spreading your investments across a range of assets to reduce your exposure and potentially increase your returns. Remember, diversification isn't about chasing the highest returns. It's about balancing risk and reward to achieve your investment goals. As the saying goes, don't put all your eggs in one basket, or in this case, don't put all your coins in one cryptocurrency. Diversification is a key strategy to mitigate risks and maximize returns in cryptocurrency investment. Investing in cryptocurrencies can be risky. That's why it's essential to have an effective risk management strategy. As we delve into the world of cryptocurrency investments, it's crucial to remember that this new frontier of finance is not without its pitfalls. The volatility of the market, coupled with the inherent unpredictability of emerging technologies, makes risk management a must-have skill for any cryptocurrency investor. One of the most fundamental techniques in risk management is never to put all your eggs in one basket. This age-old wisdom holds even in the digital age. Diversification, as we discussed in the previous scene, is a vital strategy to mitigate the risk of catastrophic losses. By spreading your investments across a variety of cryptocurrencies, you can cushion the blow if one or more of them takes a nosedive. Another technique in your risk management arsenal should be position sizing. This means determining how much of your portfolio should go into any single investment. A common rule of thumb is to limit any single investment to no more than 2 to 5% of your total portfolio. This way, even if the investment doesn't pan out, it won't wipe out your entire portfolio. Next, let's talk about stop-loss orders. These are automated instructions you give to your cryptocurrency exchange to sell a cryptocurrency if its price drops to a certain level. This tactic can help you limit your losses in a rapidly falling market. It's like an insurance policy for your investment. On the flip side, take-profit orders are equally important. These are instructions to sell a cryptocurrency when its price reaches a certain level. This strategy can help you lock in profits before the market turns against you. It's a way to ensure you don't miss out on potential gains while waiting for the price to climb even higher. Now you might be wondering, how do I decide on these levels for my stop-loss and take-profit orders? This is where technical analysis comes into play. By studying price charts and market trends, you can make educated guesses about when a cryptocurrency's price might rise or fall. But remember, these are just guesses. No one can predict the market with perfect accuracy, And that's where risk tolerance comes into play. This is a personal decision that depends on your financial situation, your investment goals, and your ability to withstand losses. Some investors are willing to take on more risk for the chance of higher returns, while others prefer a more conservative approach. Lastly, let's not forget about the importance of continuous learning. The cryptocurrency market is constantly evolving, with new cryptocurrencies, technologies, and trends emerging all the time. As an investor, it's your job to stay informed and adapt your strategies as necessary. In conclusion, risk management in cryptocurrency investment is not about eliminating risk entirely. That's impossible. Instead, it's about understanding the risks, planning for them, and taking steps to manage them effectively. By doing so, you can navigate the turbulent waters of cryptocurrency investment with confidence and poise. Risk management is the cornerstone of any successful investment strategy. And as you venture into the exciting world of cryptocurrency investment, remember that a well-planned risk management strategy can be your compass, guiding you towards your investment goals. We've covered a lot today, from understanding the crypto market to various investment strategies and risk management techniques. Let's take a moment to revisit some of the key points we've discussed, as these are the foundational blocks of your cryptocurrency investment journey. We began by introducing cryptocurrency investment, emphasizing its potential as a profitable venture, but also highlighting its inherent volatility. This volatility is not necessarily a drawback. Rather, it's a characteristic of the market that, when navigated skillfully, can lead to significant returns. Understanding the cryptocurrency market was our next focus. We dove into the intricacies of market trends, price fluctuations, and the factors that influence them. This understanding is critical as it allows you to make informed decisions about when to buy or sell your assets. We then moved on to discuss various investment strategies, starting with long-term investment. This strategy involves purchasing and holding on to your assets for an extended period, typically several years. It's particularly suited to those who are comfortable with the ups and downs of the market and who have the patience to wait for their investments to grow over time. Day trading was our next topic. This strategy involves buying and selling assets within the same day to take advantage of short-term price fluctuations. It requires a keen eye for market trends and a willingness to act swiftly. It's a more active approach and can be rewarding, but it also carries a higher risk. We also explored ICO Investment Strategy, which involves investing in a cryptocurrency during its initial coin offering. This can be an opportunity to get in on the ground floor of a potentially lucrative venture, but it also carries its own set of risks, as the success of the coin is not guaranteed. Diversification was another key strategy we discussed. By spreading your investments across a variety of assets, you can mitigate risk and increase your chances of success. It's a basic principle of investment that applies just as much to cryptocurrencies as it does to traditional assets. Finally, we touched on the importance of risk management in cryptocurrency investment. This involves setting clear goals, establishing a risk tolerance level, and employing strategies like stop-loss orders to protect your investments. It's a critical component of any investment strategy and can make the difference between success and failure. Throughout all of these discussions, one theme remained constant: the importance of research and staying informed. The cryptocurrency market is dynamic and ever-changing, and the most successful investors are those who stay on top of the latest trends and developments. Whether it's reading up on the latest ICO, tracking market trends, or studying up on new investment strategies, staying informed is your best defense against the unpredictable nature of the market. So, where do you go from here? The journey to becoming a successful cryptocurrency investor is a long one, and it's not without its challenges. But with the knowledge you've gained today, you're well on your way. Remember to stay patient, keep learning, and above all, be strategic in your decisions. Investing is not a get-rich-quick scheme. It's a journey that requires time, effort, and a healthy dose of patience. But with the right approach and the right mindset, it can be a rewarding and fulfilling endeavor. Remember, the key to successful investment is knowledge, patience, and strategy. Thank you for joining us today, and we wish you all the best in your cryptocurrency investment journey.